If you look into the math of early retirement, almost every strategy centers on a single calculation, the 4% rule. But a massive contradiction has emerged at the center of modern finance. Bill Bengen, the man who actually invented the rule, recently revised his own math and stated that 4% is actually too low. He now suggests closer to 5%. At the same time, institutions like Vanguard and Morningstar are releasing data suggesting 4% is too risky, and you should be looking at 3.5 or lower. This leaves retirees in a bizarre position. How can the world's leading financial experts look at the exact same historical data and arrive at completely opposite conclusions? Blindly trusting a 30-year-old financial headline without understanding this underlying conflict is a massive risk. Miscalculating this single percentage can jeopardize an entire life savings. In 1994, Bill Bengen set out to find an absolute worst-case historical floor for retirees. He wasn't interested in averages. He wanted to know the maximum amount someone could withdraw without running out of money, even in the harshest conditions. He was testing for sequence of returns risk, the danger that a major market crash in the very first years of retirement will hollow out a portfolio before it ever has a chance to recover. To find the limit, Bengen pinpointed the unluckiest retiree in American history, the person who stopped working in October of 1968. That retiree immediately hit the 1969 bear market, followed by the 1973 market crash, all while being choked by the massive double-digit inflation of the 1970s. Bengen discovered that even in this perfect storm scenario, a portfolio split 50-50 between stocks and bonds survived 30 years, but only if the owner capped their initial withdrawal at 4%. This 30-year timeline shows the result. In the absolute worst 30-year period ever recorded, the 4% rate allowed the retiree to cross the finish line with the portfolio landing just above zero. Bengen built this 4% floor as a financial storm shelter, specifically engineered to withstand a once-in-a-century economic hurricane. But Bengen continued his analysis long after 1994. He eventually realized that his original portfolio, a simple mix of large-cap stocks and government bonds, was poorly optimized. In 2006, he added a third asset class, U.S. small-cap value stocks. Running this optimized portfolio against the 1968 nightmare raised the safe floor to 4.5%. Further research pushed that floor even higher, to 5%. Relying on the outdated 1994 math can lead to unnecessary frugality. For someone with a $2 million portfolio, Bengen's updated research suggests they could safely spend an extra $14,000 every single year. If the historical data supports a higher rate, why are institutions like Morningstar telling people to drop down to 3.5%? It comes down to two major shifts in the retirement equation. The first of these is the time horizon. Bengen's model is built for a 30-year window, but many people now plan for retirements lasting 50 years or more. Over that distance, you cannot slowly deplete your principal. You have to transition to a perpetual withdrawal rate, living almost entirely off growth and dividends while leaving the underlying assets untouched. The second factor is the difference between looking at the past and looking at the future. Bengen's work is historical. Institutions, however, build models based on current market conditions and forward-looking assumptions. When stock valuations hit historical peaks, forward-looking models project much lower real returns over the next decade. If you retire during an expensive market peak and plan for a 50-year timeline, attempting to pull 5% creates a high probability of hollowing out the portfolio before you reach old age. Both the historical model and the modern institutional warnings share a common flaw. They assume retirees will blindly withdraw the same fixed amount of money every year, even as the market collapses around them. Modern strategies move away from fixed percentages entirely. Instead, they use a framework called dynamic guardrails. You start at a reasonable rate, like 4.5%, but you establish a downward guardrail. If the market hits a severe downturn and your portfolio drops past a threshold, you temporarily trim discretionary spending by 10%. But the system works both ways. When the market booms and exceeds targets, the upward guardrail allows you to safely increase spending. Long-term security comes from building an adaptable system that can absorb market shocks while allowing a retiree to enjoy the wealth they spent decades building.